Good morning, ladies and gentlemen. So, today what we're going to be talking about is a new topic, and it's basically the final topic in terms of major content for looking at futures markets, which is how we actually use them to hedge. Just a matter of point, I'll actually be taking this lecture and also next week's to help out Gary. He'll be sending you an email either later this week or next week about the trading simulation that you have to participate in. So there's a futures trading game that you need to take part in as part of the course. And that takes part in week 12. And he'll be sending out an email with instructions of what you need to do. So he'll come back in week 11 to explain a little bit more about that. And then in week 12, the actual trading game takes place. So the material that I'm covering is quite useful because you might use some of it. And in particular, what we talk about here when we're looking at futures hedging, it is very different to that of options hedging. The concept of the hedge ratio might be the same. The hedge ratio tells you how many futures contracts you need to take out for a position in the spot market, but how we actually calculate it is very different, and the reason why we develop a hedge is also different. So that's what we're going to be focusing on. Now, before we go into more depth, I might have talked about this already a little bit last week, but I'll just go over it again in any case. When we look at hedging, the question is, why would you want to hedge? So, on the face of it, there seems to be a number of good reasons. For example, you might be operating a small business and you're worried about the foreign exchange price, the currency price, what you can sell your exports for, or how much you have to pay for your imports. So actually taking out an FX, a foreign exchange forward contract or futures would be quite useful. However, at the same time, as I'm going to demonstrate today, when we look at hedging using futures contracts, I like to say it's more of an art form. It's more like art than it is a science. And the reason being, you are not guaranteed that the hedge is going to work. So it can give you a misleading impression of the amount of risk that is actually reduced. And the reason this is the case is because of what we call basis risk. So this is what I'm going to talk about straight after this. I'm going to examine what basis risk means and how we actually apply it. Hedging eliminates the opportunity to take advantage of favorable market conditions. What do I mean by that? Well, let's say I think that the stock market's going to go down. So if I want to hedge against that using futures contracts, what would I do? What would be the easiest thing? If I've got a portfolio of stocks and I think that the stock market's going to go down, what would be the easiest thing to do?
Short.
Short what?
Short. SPI?
Yes, the index futures. Here in Australia it's the SPI, that's correct. So short index futures would be the way to go. Now, if you do that, but the stock market actually goes up, what have you effectively done? You've actually stopped yourself making any money, because you have a long position in the spot, which is the stock market, a short position in the futures, and they cancel each other out. So every time you actually take a hedge, you reduce the possibility of actually making money if the situation doesn't materialize as you expect. And then this leads us to my final comment, which is that there is in fact no such thing as a hedge. Why can I say that? Well, if you think about it, every time you hedge, you are speculating about the future. If I think the stock market's going to go down, that's speculation. If I therefore take a short position in index futures, I'm speculating that the stock market's going to go down. So whenever you actually take out a hedge, you have to remember, in fact, it's not really you trying to cover yourself for an insurance policy. It is, in fact, a form of speculation. And so that needs to take into consideration whether you decide to hedge or not. It's a very important consideration. So, for example, in the fund management industry, it is a controversial subject whether an international portfolio of stocks and bonds should be hedged against foreign exchange exposure. Whether if you have positions in the US, in Europe, in Asia, whether you should actually also reduce the risk from foreign exchange exposure. Some people will say yes, you need to. Other people say no, because you don't know which direction it could take. And that's just a form of speculation. So you'll find some international portfolios to actually be hedged and some not. And that depends on the individual position on whether it actually makes sense or not. Okay, so we have to go through some terminology that's very important that leads us then to understand what a hedge ratio does in the context of futures contracts. So we can have two different types of hedges. We can have what's referred to as a short hedge and a long hedge. A short futures hedge means two things, in fact. It means not only have you gone short on the futures contract, but you've taken a corresponding opposite position in the spot. So if I've gone short on futures, I go long on the spot. If I've developed a long futures hedge, it implies that I've gone long on the futures, short on the spot. So that's the definition of a short futures hedge and a long futures hedge. It involves two positions. Very similar to a delta hedge with options, right? If you've gone long on calls, you need to go short on the spot, on the stock, shall I say. Now from this, we arrive at something called basis. Basis is the difference between the spot price and the futures price. Let's look at an example. I buy a stock today, a spot, should I say an asset? It doesn't have to be a stock, it can be a bond, whatever, it doesn't make any difference. I buy any type of asset today, and I pay $100 today for it. I also go short on a futures contract for the asset that I will be able to make $103 at the time of termination. So if I buy the asset today for $100 and I go short on the futures, I can sell that asset that I've bought for $103. It does not matter what the final spot price is. If I hold to expiration, I will be guaranteed to make $3. Why is that? Because I know one thing. At expiration, the spot price must equal the futures price. If the spot is at $97, the futures price must also be at $97. If the spot is at $207, then also the futures must be at $207. So, can someone tell me why must the spot and the futures be identically priced at the time of termination of the contract? We covered it last week.
Otherwise it would be an arbitrage profit.
That's right. And in particular, I referred to one particular term to explain this. Why must a spot equal the futures contract at termination? That's correct, but I'm looking for a particular terminology here. Yes, the law of one price. The law of one price means if you have two items that are identical in every way, then they must be priced the same. In other words, the price must be identical. You have what we call the law of one price. That's basically what I'm looking for. So, we know that basis at termination of a futures contract is equal to what value? To what price? 0, right? It has to be equal to 0. In other words, if you hold any hedge until expiration, you are guaranteed to make initial basis. You're guaranteed to make the profit which is equal to initial basis. Why? Because at the end of the day, your profit is going to be final basis minus initial basis. And if final basis is 0, then you know for sure that your profit, before you even come to the expiration date, is going to be initial basis. You're guaranteed to make the difference between the futures and the spot here. So first of all, let's just recap on some terminology. Buy asset, sell futures. This is a long or short futures hedge? Short futures hedge. Is the market in contango or backwardation? Contango. Therefore, does this imply that whenever a market is in contango, like in this example here, the futures price is above the spot, if you take out a short futures position and hold to expiry, you're guaranteed to make money. Is that what it's saying? In this example here, the futures is above the spot, so I buy the spot, I short the futures, and I wait. I wait till expiration. I then buy back my futures or execute it, and I receive $103. I'm guaranteed to make $3. So is it telling me that every time I find that a market is in contango, I can guarantee to make money? Most markets around the world for futures tend to be in contango. Particularly, they tend to be in contango. Does that mean you can just make money for nothing? There's no risk? What's wrong then with my analysis? What am I missing? Go on. Yes, that's very good. Very good answer. Not many students give me the right answer first time round, so that's good. So this $3, is it really profit? No. This is the cost of carry that we talked about last week. The fact is, if I decide to buy the asset today, I have to pay $100. If I didn't buy the asset, what could I do with the money? Yeah, I could put it in the bank earning interest. So at the very least, I have interest foregone, right? If this is a financial future, then the $3 is nothing but the interest foregone. If I'm looking at a commodity futures contract, then this may be the interest foregone and the storage cost, right? Which together create cost of carry. So this is not really a profit. This is simply the opportunity cost from choosing to hold the asset and pay for it rather than, in fact, taking the futures position. This is not a profit. Okay. So, if we hold until expiration, we know that at expiration basis is going to be equal to 0, so B large T is equal to 0. So our profit is always going to be initial basis. If I therefore hold a short or a long hedge until expiration, is there any risk? No, there's no risk. Why can I say there's no risk? The answer is quite simple, in fact. Sorry?
No profit.
It's true you make no profit, I agree, but that's, you are right. But that's not technically the reason why you can say the short or the long hedge is risk-free. There's another reason for it. You can make a 0 profit and still be in a risky position, right? So you are correct that you don't make any money, but the reason why it's risk-free is slightly different. Risk-free, let's say you take out a position and you do not know what the future holds for it. Is this risky or not risky? Risky. If you take out a position and you know what the future holds, is this risky or not? Not risky. So in order to determine whether a strategy is risky or not, it doesn't matter what you look at. It doesn't even have to apply to finance. It could be anything that you do, whether you go for a job or not. If you know what the outcome is going to be, then there's no risk involved, right? So, if that's the case, then let's look at this particular example. Do we know what profit we're going to make? Yes. We're going to make what? Initial basis, right? We know that the profit we're going to generate is going to be equal to initial basis, because final basis is always going to be the expiration base is always going to be equal to 0. So we know, as we create our portfolio, if we intend to hold it to expiration, we are guaranteed to make a certain amount of money, which is equal to initial basis, which is basically our cost of carry. So that's the reason why it's risk-free. And this, therefore, leads us to understand what basis risk is all about. So if you have time on the horizontal axis, and let's say this is my futures price here, and this is my spot price, then I'm guaranteed that at expiration, my final basis, B large T, will equal 0. Because I know, due to the law of one price, the futures price must equal the spot. However, any time before expiration, that is not necessarily the case. The spot price may be above the futures price. So we are in what? Backwardation. And sometimes the futures price may be above the spot. So any point in time, we might see a pattern that looks like this. It might vary more often. We do know, of course, they have to follow in roughly the same pattern. Why? Because at the end of the day, they have to end up at the same place, right? So they will drift together, but they will not necessarily be equal to each other, and they will move not necessarily in perfect harmony. In other words, if you decide to terminate a short or a long futures hedge before the expiration date, you are exposed to basis risk. Basis risk is the fact you do not know what basis is going to be at time B small t. This could be anything. It could be a positive number. It could be a negative number. It is purely unpredictable. So, a long or a short futures hedge is only risk-free if you hold it until expiration. If you decide to close out your position prior to expiration, you run basis risk. And the examples that I'm going to show you later on are going to demonstrate that this is the main reason why you do not know if the hedge is going to work or not. Because if you intend to close out before expiration, which is most of the time, then you do not know how effective the hedge is going to be, because basis risk, basis at B small t is unpredictable. So I want to instill that particular point, because I'm going to come back to it later on, and I mentioned it a few times because most people take a while to understand this. It's actually an important concept. So having a long or short futures hedge is only risk-free if you hold to expiration. Any time before that, you are exposed to basis risk. So let's look at an example. Gold spot is at 387. The futures price is at 388. So we have contango. We buy the spot, sell the futures. This is a short futures hedge. My initial basis is at 1.45, the spot minus the futures. If I hold till expiration, it doesn't matter what the final spot price is. It could be $408, it could be $2. It's immaterial because the spot will always equal to the future, right? My profit is going to be equal to $1.45. It's going to be equal to initial basis. It cannot be equal to anything else, so there's zero risk. However, what happens, oops, let's go back to here. What happens if I actually close out my position prior to expiration? Well, then suddenly the spot does not have to equal the futures contract price. Here, the spot is still less than the futures. So the money that I make from the, I lose from the spot, I make a little bit more from the futures when I close out my position at time small t, and my net gain is now 34 cents. That is my current basis of B small t minus my initial basis. So I still make a little bit of money, but it could very well be that the futures price is below the spot price. If that's the case, I would have lost money. So the fact is, because it's unpredictable what basis is going to be at time small t, I may make money or I may lose money. I really don't know. I have basis risk. So basis risk forms a significant proportion of the unpredictability of whether a hedge is going to work or not. Because you might think to yourselves, well, hang on a second, why is Ralph making a big fuss about whether, you hold your contract to expiration? I'll just hold till expiration. The fact is, the majority of the time, the contract that you are hedging with expires at a time that's not convenient for you. If you think the market's going to go down in the next month, and the only contract that you can take out is an index future that expires in 6 months' time, then you run basis risk, right? There's a difference between your holding period, your investment period, and that of the contract. Okay. So there are actually other type of risks as well, which I'm going to go through now, just so you're aware, and this also causes problems. So the first one, I'll just go through it. Basically is that the fact sometimes, particularly during crisis periods, the spot and the futures may move in opposite directions. So even in my simple example here, you might find that for short periods of time, let's say the spot is moving down where the futures actually moves up. Now this causes a problem. Why? Because if I've gone short on the futures, and the futures is actually going up, and I've gone long on the spot, and spot's going down, I'm losing twice. I'm losing double the amount than I would normally do. Now, this will only last for a short period of time. We do know, of course, they have to trend together eventually. They have to follow the same trend in the midterm. But for the short term, you can run the risk of being exposed to a large loss. And in particular, what type of problem do I encounter, therefore? For a short period of time, the futures and the spot may move in opposite directions, which is going to cost me what? What am I going to have to do for that short period of time? Yeah, your margin account, right? Think about the margin call. You're going to have a lot of cash available, liquidity, to put into the margin account to meet the margin calls. Yes, you'll get that money back eventually, but the question is, are you liquid enough? So that's the question. It's a risk that you have to run, right? There's what we call a liquidity risk. A liquidity risk associated with the spot and futures prices diverging, moving away from each other. Okay. The next risk that's worth talking about is quantity risk. This is particularly important in the case of commodity futures contracts. And I'll give you an example that happened here in Australia. Australia went through a 10-year drought, decade drought, about 5 years ago. It's finished. And if you were in Australia at that time, particularly here in Adelaide, for literally 10 years, it really didn't rain a lot. And this caused problems for farmers. Now, several years ago, financial advisors told farmers that they should take out a futures position in wheat so that when they harvest their wheat, they can be guaranteed the price they can sell it for. Now, would they be taking a short or a long position? Short, right? They're going to deliver the wheat and receive a certain amount of money. Now, wheat is usually measured in what we call bushels. B-U-S-H-E-L-S. It's a form of measurement for wheat. And let's say one futures contract is on 1,000 bushels. That basically implies that you, the farmer, have taken a short position on wheat futures in, let's say, 3 months' time, when the harvest comes, you have to deliver 1,000 bushels. But because the drought is more severe than you expect, when you harvest, you only end up with 600 bushels. You are 400 bushels short. What do? That's right. You have to go to the spot market and buy the extra 400 bushels so you can live up to your obligation of delivering at the time of the termination of the futures contract 1,000 bushels. Now, when you go to the spot market to buy these extra 400 bushels, do you think the spot price will be high or low? It's going to be very high because all these other farmers are doing exactly the same thing. Demand is very high, supply is very short. Suddenly, these farmers are losing a lot of money. They're selling their majority of their wheat at a reduced price through the futures contract and having to go to the spot market themselves to buy extra wheat to meet their deficits. They actually lost out a lot of money. So these farmers got together and they formed a class action lawsuit. That basically means a class action is when many people come together and they sue at the same time. So they fought in the law courts, this financial advisory firm, saying they were unprepared or were not given the full details of how the futures contract was going to work. And they actually won some money back, because there was evidence that the financial advisors did not explain to them quantity risk. The risk that basically the futures contract quantity that's in the contract specification is different from what you actually want to deliver. So there you go.
Would it be better to just close out your position rather than let the contract, like the short position, just till time to expiration? Shouldn't the farmers have just taken a long position out like a month before expiration or something like that?
I think you are possibly right. And again, that might have also been the reason why they sued the financial advisors, because the advisors did not provide advice prior to the termination date that they needed to get out of the position. Because most people this you might find quite interesting. If you go out into the bush, so if you go out to the farm or agricultural lands here in Australia, you don't get the same radio stations, right? You don't get pop music, or well, you do, but more country music. But what they'll have is regional news channels, and regularly they will tell you on every 2-3 hours, they will read out the futures prices for cattle, for wheat, and whatever. Because unfortunately, for farmers nowadays, they have to not only farm the land, they also have to trade futures contracts. They have to be their own financial traders, because they cannot rely on good financial advice, so they have to do it themselves. So they will be listening whilst they're in their tractor to futures markets, working out whether they need to trade or not. But you have to remember, these people are they're going to want to hold to expiration, really, right? They're not wanting to gamble, to speculate. That's not their job. But they still have to know whether they take a position or not. And so that causes problems. Okay. So the next issue, and I don't spend much time on it, there's another course that looks at it, Treasury and Financial Risk Management, which is to do with cross-hedging. The fact is, a lot of the time, you cannot find a futures contract to hedge the spot that you're interested in. So, for example, you're looking at platinum. You're a platinum trader. But you cannot find any platinum futures contracts. However, you noticed that gold futures contracts, that's price series, is very highly correlated with platinum. And so you use gold futures to hedge platinum spot. And this is referred to as a cross hedge. How effective it is will be dependent upon the correlation that the futures price has with the spot. I have already talked basically about expiration risk. Expiration risk is where the futures contract expires at a different time to when you want it. Maybe you want to hold the contract for longer than the futures contract has life left. Or sometimes you want to hold it for a shorter period. In whatever the case may be, expiration risk leads to what type of risk? Basis risk, yes. Leads to basis risk, right? Basis risk exists because you do not know what the spot and the futures price is at any point in time, except for the date of expiration. In other words, if your expiration date of the contract does not match up with your investment horizon, you have basis risk. Okay. I've also already talked about this as well. When futures and spot prices do not move in the same direction, but they diverge, then you're going to receive, very likely, margin calls. And you have to ensure that you are liquid. So there's a liquidity risk involved in being able to make margin payments. Okay, so what I'm going to do now is introduce you to the first type of hedge ratio that we cover in the course. There are two different types of hedge ratios, and they're used for completely different things. And a lot of students get confused between the two. So I want to ensure as much as I can to separate the reason why you use one hedge ratio versus the other. The first hedge ratio that I'm going to talk about is when the futures contract is identical to the underlying in terms of what it is trying to hedge. So, if I'm interested, if I've got a spot position in gold, I've gone long on gold, and I want to hedge that with futures, then obviously the most obvious thing to look at would be gold futures, right? So gold futures is on gold. They're on the same identical product. It's the same with, let's say, BHP. It's the largest mining company in the world. Let's say I'm worried that China's not buying more iron ore. My BHP, which I have a large stock, is going down. I want to hedge that position, so I go short. I go short on BHP futures. So if I do that, then again the financial contract on BHP is the same as the spot. If they're identical, then the hedge ratio that I need to focus on is the one I'm going to present now. Simply put, the hedge ratio has the same meaning as what you had to look at when you were covering options. It's the number of futures contracts to hedge a particular exposure in the spot market. The most simplest type of hedge ratio that can be calculated in this particular case is referred to as the naive hedge. Naive is actually a French word, but is used in English as well. It basically means ignorant, simple, right? A simple, ignorant, to a certain extent, hedge ratio. Why do we say it's a little bit ignorant? Well, the naive hedge implies that there is a one-to-one relationship between the spot and the future. So, if I have 10 positions in the spot, then I need 10 positions in the future in the other direction. That's what it's saying. What does that mean in terms of, or what does that imply in terms of how the spot and the futures price move together? What does that mean? If the spot goes up by 1%, how much would the futures go up by? 1%. If the spot goes down by 3%, then of course you also expect the futures to go down by 3%. In other words, the correlation is equal to 1, right? There's a 100% relationship between movements in the spot and the future. That is what is implied through a naive hedge. Is that how futures and spot prices move? No. We already discussed that in reality, at any point in time, they will be around the value of each other, but not exactly the same. So this is a naive hedge. It's a very simple view of how things are. Having said that, the reason why we talk about it is because in the real world and also in academic research, people have shown that the naive hedge works pretty much just as well as more complicated hedge ratios. I'm going to show you a more advanced method just in 1 second. But in fact, this advanced method has been shown not to be significantly better than the naive hedge. And I'll show you why that is, again, also, after I've explained it. So the naive hedge sounds very basic, very simple, but in reality, it is probably working just as well as any other type of hedge. Okay. So the second method is referred to as the minimum variance hedge ratio. And to understand that, we have to realize that in reality, when we want to look at the relationship between spot and futures, it doesn't have a correlation of equal to 1. They're not perfectly correlated with each other. So what we want to capture is what is the ratio between changes in the spot price for changes in the futures price. That's what we want to work out. And that will tell us the number of futures contracts that we want to hedge. There is a negative sign here, but you have to ignore it. The negative sign does not tell you whether you go short or long. It comes due to the algebra, which I haven't shown here. So the algebra leads to the negative sign. That's basically it. Let's look at it a little bit more. The minimum variance hedge ratio, well, let me explain it first visually, and then we can look at the equations. Ideally, what we want from a hedge is what type of profit. If we have taken a long or short futures hedge and it is working perfectly, what profit will we receive? 0, right? We're going to get 0 profit. That's what we're after. So, if I have profit here on my vertical axis, so this is positive, this is negative, so profits, losses, then ideally, if I have a perfect hedge, my profit over time will be equal to 0. Is this possible? No. It is only possible in one particular case. What is that case? I've gone over it several times. You'll only make a zero profit, a guaranteed perfect hedge, if you do what? Anyone? If you hold to expiration, right? If you hold to expiration, you're guaranteed to make initial basis, which is not really a profit, right? It's cost of carry. Okay. So that's why I said it's not that an easy concept to understand. You think you understand it, but really it's not there. It takes a while to grasp. So, as long as you do not hold until expiration, you run what type of risk? Basis risk, right? And that basically means a spot in the futures price could be anything, and therefore your profit will not be equal to zero for your hedge. Now, would you prefer, over time, to have your profit to behave like this? Or would you prefer for it to behave like this? The red or the blue? Which one would you prefer? Yeah? Which one, which type of strategy is giving you a better hedge? The red or the blue? The red, right? The red clearly is giving you a better hedge. If your goal is to hedge, it is not to make money, right? The goal is to get as close as you can to the zero line. So, what we want to do is find a method that minimizes the variation of your profit over time. Hence the name, the minimum variance hedge ratio. It is the hedge ratio that minimizes the dispersion, the variation of your profit over time. Because the closer you can get it to zero, the better. That's the goal. So, the profit from a hedge, it doesn't actually have to be a short hedge. It could be a long hedge. It's immaterial. The profit from a hedge is going to be equal to changes in the spot price plus changes in the futures price multiplied by the number of futures contracts. Obviously, you're going to take a opposite position in the futures than you will to the spot, right? But other than that, that's what your profit. You want it to be basically zero. In reality, we know that spot and futures do not move with each other the same, so you run basis risk. So what we want to do is find a way to minimize the profit over time, the profit variation over time. So if we look at the variance of the profit, this is our variance equation, which you should be familiar with. The variance of the profit is equal to the variance of changes in the spot price plus the variance of changes in the futures price multiplied by the number of futures contracts plus the covariance that spot prices have with futures price changes. And from that, if we solve for NF, the number of futures contracts, we end up with this equation here. The number of futures contracts that we need to hedge is equal to changes in the spot, is a covariance between changes in the spot and futures prices divided by the variance of changes in the futures price. This is identical to the equation. This is why I say that you should be familiar with this. This is identical to the equation for what? What other model uses this? Yes, the CAPM, right? The capital asset pricing model. What you've done is effectively calculated the beta. This is not systematic risk, but this is basically the equivalent, right? The equation is the same. The equation used for calculating the beta systematic risk within the capital asset pricing model is the same for working out, at the end of the day, what the hedge ratio should be, the minimum variance hedge ratio. So there is a question in your tutorial that goes through this, that asks you to download some data from the MyUni website and to work out the hedge ratio. So it's worth doing because that's not something I can do in the lecture, but in the tutorial it's definitely worth covering. Now, if you run a regression to calculate this value here, This is the explanatory variable. Then, when you run a regression, you'll also get output that contains the R-squared. The R-squared is the coefficient of determination, and it tells you how good does your regression explain the data. Now, can someone remind me, what does the R-squared value range equal to? What's the range that R-squared could be equal to? Yes, 0 to 1. And 1 means what? Yeah, a perfect fit, right? Sometimes we call the R-squared the goodness of fit, how good the model fits the data. So if you have a value of 1, then it's telling you the data works perfectly for the regression. In regards to futures contracts, we have a different interpretation of what R-squared is. We call R-squared hedging effectiveness. Hedging effectiveness tells you how likely will the hedge be effective. What's the probability that the hedge will be effective? So, if you get a score of 1, it means 100% of the time your hedge will work. You will have a profit close to 0. If the R-squared turns out to be 0, it means forget about it. It's not worth doing. The hedge is not going to be successful. When you do the tutorial question, you might be surprised as to what the R-squared will be. Do you want to have a guess what the R-squared is likely to be for this type of model? Yeah, okay, a few different opinions. It is going to be somewhere in the middle, about 0.5. Most short futures hedges, most long futures hedges will be 50% of the time working. The other 50% of the time, they will fail. So, if you go back to my earlier statement at the beginning of the class when I said that, futures hedging can give you a misleading impression of how effective they are, then this is an example that you'll find in your tutorial when you do the question. The R-squared is not particularly high. It's not close to 1. Sometimes you can get it to 0.6, so 60% of the time it will work, 40% of the time it won't. But that's what people are happy to live with, because that's the only option. There's no other choice. If you intend to close out your position prior to expiration, you run basis risk. Basis risk is unpredictable. In some type of markets, it's more predictable than others. Therefore, the R-squared will be slightly higher, but it will never be equal to 1. So just before we take a break, I might just go through one other slide before we start looking at the other type of hedge ratio that I was referring to. That's completely different. So before we do that, there's a slide here that Gary covers, and how useful it is nowadays I'm a little bit unsure, because we live in a very low interest rate environment. Around the world, interest rates are very low, and they have been like that for a long time now, for quite a few years. And when interest rates are low, then the practice of tailing the hedge basically is redundant. It's not very useful. What tailing the hedge does is allow you to take into consideration the amount of money that you will make from holding cash in the margin account. Because the clearinghouse requires you to hold money in the margin account, it does pay you interest. I mentioned this last time. It pays you a small cash rate, interest rate, right? So you are earning money in there. If the interest rate is large, then you're earning a little bit of money. So it's worth taking that into consideration when you take out your hedge. Because if you consider that the interest rate is on your cash deposit for your margin account is safe, then it's contributing to your hedge. That's the way to look at it. So, Here, the spot price is at $1, the interest rate is at $10, and let's say you hold 10,000 shares and one futures contract is on one share, so you go short on 10,000 futures contracts. What type of hedge is this? It's a short hedge, and also it's a naive hedge, right? We're using the naive hedge ratio here, 1:1. Now, without telling the hedge, I go short on 10,000 futures contracts. But with telling the hedge, if there is 100 days to expiry, then I actually only go short on 9,745 futures contracts. That's equal to 10,000 multiplied by the interest rate of 10%, to the power of, discounted by 99 days. 2 days prior to expiration, I do the same thing, but I discount only by 1 day. And so the number of futures contracts I need to hold has gone up. It's now gone up to 9,997. The day before expiration, I need to short 10,000 futures contracts. So as days get closer to expiration, I have to go short on more and more futures contracts until the day before I actually have the exact number. The reason I'm not taking out full number of futures contracts is because I know the interest that I could potentially earn from the margin account can offset some of that cost. Now the question is this: why am I only deducting 99 days if there's 100 days left to expiry, or only 1 day if there's only 2 days left to expiry? Very good, excellent answer. It's because we do not have daily settlement. We do not have mark-to-market accounting 1 day prior to expiration, right? We stop 1 day prior to expiration. So it's 99 for 100 days. It's 1 day for 2 days. Now, I said that it's not worth doing if interest rates are quite low. The reason being, if the interest rate is low, then the marginal cost of telling the hedge is higher than the marginal gain. What is the cost associated with telling the hedge? What am I doing on a regular basis? It doesn't have to be a daily basis. What am I doing on a regular basis?
Increasing the contract?
Yeah, I'm having to go short on more and more futures contracts. So what cost am I talking about here? Yes, rather than doing just one transaction cost to go short on 10,000 futures, I'm doing multiple transactions throughout the life of the contract, right? So this is going to increase my total transaction costs. So the only benefit of telling the hedge is where the cost of the extra transaction costs are less than the savings you make from the interest. In other words, it only is going to work if the interest rate is quite high. Okay. So nowadays, you don't hear about telling the hedge. It basically doesn't exist anymore. But then again, you might find it in the future. Interest rates environment changes in the world, and it'll be quite popular. Okay, good. So let's take. I won't take a 10-minute break. We'll just take a 5-minute break, and we'll finish early. When we come back, we'll look at the next type of hedge ratio. Okay, so the second type of futures contract second type of hedge ratio that we will be looking at it's for a slightly different purpose. And so the equation is also different. A lot of the time, particularly with stocks that I'm going to be showing examples of, there are not individual share futures contracts for the underlying. Unlike options where you have a multitude, a large number of options on individual shares, this is not the case with futures. With the largest market around the world being in the US, and there are thousands of stocks listed in the US, it is pretty much only probably the top 500, 400 stocks by market capitalization that are in the S&P that actually have individual share futures on them. So even in the US, you do not have a great selection of share futures for particularly medium-sized stocks. Here in Australia, maybe the top 20, 50 stocks have futures contracts on them, and that's it. So this causes a problem. If you want to use futures contracts to hedge a underlying position in a stock that does not have an individual share, then you must find an alternative. And the alternative that we use turns out to be the Index Futures contract. The Index Futures contract probably is the foremost important futures contract that is traded in pretty much most exchanges around the world. It is used because it is a proxy, a substitute for what we really want to use, which is the individual share future. Now, the examples that I'm taking are from Don Chance's textbook, a very old version of it at least, which is one of the recommended texts for the course. And so we basically are looking the US, and that's why I'm talking here a little bit about the S&P 500 futures contract. The S&P 500 futures contract is the primary index futures in the United States. There are other ones, but this is the main one. And it has a contract multiplier. The contract multiplier is $250 per point. So if the futures is currently at 1,300 points, it means one futures contract costs $325,000. So as you can see, again, it's not just in the US but around the world. Share futures and commodity futures, we're dealing with large sums of money. They're not for individuals like you and me to trade. In the case of options, you have many day traders, mum and dad investors who trade options, but not futures contracts. There is an alternative to futures contracts, and they're called CFDs, contracts for difference. Contracts for difference used to be traded on the ASX, but they are no longer. You have to go through a third-party provider, so like CMC Markets or IG Markets. They will offer you contracts for difference. I won't go into detail what contracts for difference are, but to say they're like a mini version of futures contracts. They're for people like you and me, retail investors, to trade. Okay. The appropriate hedge ratio. In this particular instance, when we're looking at index futures for hedging something that is not the perfect portfolio itself, is equal to this equation. And I think it's worth you writing down what I'm going to say, because I'm going to give you a definition of what this actually stands for. The number of futures contracts to hedge, is equal to the systematic risk of the portfolio multiplied by the value of the portfolio divided by the price of one futures contract. So, the systematic risk here is represented by beta. The S here is the spot price. But what I'm referring to really is the total value of the portfolio, total value of the underlying, okay? And F is the price of one futures contract. We ignore the negative sign. Even though I say it, many people ignore what I say, unfortunately. But the negative sign tells you nothing about whether you go long or short. It's there because of the algebra. Again, I don't show the algebra, but it appears. And if you pick up a textbook, it will include the negative sign because, technically speaking, this is how the equation looks like. It doesn't mean you go short. You have to work that out from the actual question, okay? Sometimes it's easy to determine whether you go short or long. Sometimes it's hard. So I'm going to show you a couple of examples of that. So we'll go through a few examples. 3 examples to be exact. Here's the first one. In March, a portfolio manager is concerned that the market over the next 4 months possibly might go down. The portfolio has accumulated an impressive profit, which the manager wishes to protect over the period ending in July. So that's in what, 3 months? March, April, May, June, July. 4 months' time, yep. The prices, number of shares, and betas are given below. So here we've got the different type of stocks, the price for each stock, the number of shares, the market value. So that basically is the market value of not only for each stock, but for the total as well. So Federal Mogul, we multiply $18.90 with 18,000 shares. That gives us $340,000, right? We add all that market value for all the other shares up, we end up with a total portfolio value of $7.7 million. Now, each stock has a weighting, of course, dependent on the number of shares we've bought in the portfolio, the market value, should I say. So Federal Mogul has a 4% weighting in the portfolio and has an associated beta of 1. So, if we're going to apply this equation here, we need to work out the portfolio beta, the total value of the portfolio, and the price of one futures contract. Well, we know what the total value of the portfolio is. It's $7.7 million. We've just basically determined that. The portfolio beta is going to be equal to the weighted average of all the betas for the stocks. So that's been calculated here. We end up with 1.06. So is this beta of 1.06 greater or smaller than the risk of the market portfolio? Greater, yeah? Greater. By how much greater? 6%. 6% greater, right? So it's actually quite close, believe it or not. 1.06 basically is close. Okay, so we've calculated beta. We know the value of the portfolio. The only thing that remains is the price of one futures contract. So the index is currently trading at 1305, the futures index. The multiplier is $250. Therefore, the price of one futures contract is $326,000. Now, all I have to do is stick in these numbers into my equation. I end up with a number of 25. Do I go long or short on 25 futures? Short. Why do I go short? Yep. I've gone long on the underlying, therefore I must go short on the futures. I must develop a short futures hedge. In 4 months' time, in September, sure enough, the portfolio manager was right. Prices in around the stock market have gone down. The portfolio was previously worth $7.7 million. Now it's worth $7.5 million. So we've lost roughly $200,000. However, I went short on 25 futures contracts. Each of those future contracts are now worth a little bit less. They were worth $326,000. Now they're worth about $324,000 each. So they're $2,000 cheaper, right? So I can buy back the futures contracts cheaper than what I sold them for, making $2,000 profit per contract on the 25 contracts. So I lose $200,000 from my stock. That represents a 2.7% loss overall in my portfolio. However, I make a $60,000 gain from my futures transactions. So the overall loss on the stocks was effectively reduced by the 60 grand, meaning that I only saw a reduction in my total portfolio equaling 1.9%. So, if I had not taken out a futures hedge, I would have been exposed to a 2.7% loss. With the futures hedge, I'm now only exposed to a 1.9% loss. Can someone tell me why am I still experiencing a loss of close to 2%? Why isn't this equal to 0? Yes, the portfolio definitely is not equal to the market portfolio, right? If you want a diversified portfolio, how many stocks should you hold roughly?
It would depend on what stocks they are as well, though.
No. To a certain, little bit right, but not quite. No, you still need a minimum number, roughly speaking. You need a bit more. There's about 20 to 30. Most people recommend 30 stocks. 20 you can maybe get away with. Why? Why is that? You should know this, portfolio theory.
Markets?
Sorry?
Markets?
No. What type of risk am I running by holding only a few stocks, let's say 8 stocks here? What risk am I exposed to? Not systematic. Unsystematic risk, right? I'm exposed to firm-specific risk, idiosyncratic risk. A portfolio that is not diversified is exposed to the risk of individual firms affecting the total payout of your portfolio. You can minimize and in fact get rid of completely idiosyncratic risk by holding a diversified portfolio. Because the only risk you cannot get rid of is what? Systematic risk. That is why, if you really understand the capital asset pricing model, the only risk you are compensated for as an investor is systematic risk, is beta. When you look at the CAPM model, it doesn't say, okay, I want a return because I've got high systematic risk and I have high firm risk. I want compensation for that. No. The market will not give you compensation for taking on firm risk because it assumes you diversify that risk away. So it doesn't mean people don't do that. I personally also buy individual stocks. But I also realize that I'm taking on extra risk that I'm not going to be necessarily compensated for. I'm gambling, right? That's what I'm doing. But it's important to understand that. So, what the futures contract does, well, let me change around. What does it not do? Does the futures contract get rid of firm-specific risk? Does it get rid of unsystematic risk? No, it cannot do that. What type of risk does it play with? Systematic risk. That's the only risk it can actually get rid of. So, the reason why this may not have been successful is because A, the portfolio may not have been diversified, so you're exposed to idiosyncratic risk. There's another reason why this may not have worked. It doesn't say it explicitly. Oh, yes, it does. Okay. Well, I'll give you a clue. We start off in March, and the portfolio manager is worried about what happens over a 4-month period until July, right? And the portfolio manager uses September futures contracts to hedge the position. Therefore, what risk are you also exposed to? Very good, very good. You're exposed to basis risk because the futures contract expiry date in September is different from the date you want to close out your position, which is in July. Okay. Let's look at another example. This is referred to as an anticipatory hedge of a takeover. In July, a firm has decided to begin buying up Helix Technology with the ultimate objective of obtaining controlling interest. The acquisition will be made by purchasing lots of 100,000 shares until sufficient control is obtained. The first purchase of 1,000 shares will take place in August. The stock is currently priced at $26.50 and has a beta of 1.8. So, this is a little bit different from the previous example. Here, we intend in the future to buy some shares. Not now, but in the future. And to a certain extent, we want to lock in the price because we're afraid, well, obviously, the price may become more expensive. So, what position do we take in the futures? Do we go long or do we go short? Long, right? We're afraid the stock price may go up, so we can't go long on Helix Technology futures contracts. There aren't any. The next best thing we can do, we can use a proxy, a substitute, that being the index future. We'll go long on the index future contract. So, in July, 100,000 shares are worth $2.65 million. If I can't take an individual share futures contract out on that, I have to look at index futures. So the price of one index future, the S&P 500 futures, is $315,000. So I need to go long on 15 futures contracts. That is the beta of the stock, 1.8, multiplied by the value of the portfolio, which is 2.65 million. This is the value hypothetical value that I will be taking out, divided by the price of one futures contract, which is $315,000. So I buy 15 futures contracts. In August, in 1 month's time, sure enough, the stock price has gone up. It was $26.50, now it's $28.75. So it's risen by, well, at least a couple $100,000 there. It's now $2.875 million worth. However, I bought 15 futures contracts at $315,000, and each futures contract is now worth roughly $332,000. So that's what, that's about $17,000 profit, something like that, per futures contract if I now sell them. So I make money from the futures. When the 100,000 shares are purchased in August, they cost an extra $225,000. However, sorry, excuse me. However, I make money from selling my futures contracts, which are worth more now, and the total of that is $250,000. So, in fact, I make a small profit of $25,000. I lose $225,000 from the cost of the shares going up, make $250,000 from the futures contracts. I effectively end up with a price for each share of $26.25. That's 25 cents cheaper than what they originally cost in July. Has this hedge been perfect or imperfect? Imperfect, right? Imperfect. The reason being, you made money. You're not going to complain, right? No, you're going to say, oh, I didn't really want to make money. But at the end of the day, it wasn't a perfect hedge. A perfect hedge theoretically means you make $0. So again, why would you may not have experienced a perfect hedge? Well, it's true. It probably makes a small difference, probably not a big difference, but it does make some difference. You can't buy exactly the right number of futures contracts. That's correct. The main reasons are what we already discussed. First of all, you're suffering from basis risk, right? The futures contract doesn't expire till September, but you're closing out in August. Secondly, of course, and we're very lucky, in my opinion, that this actually worked, because you are running a very large risk associated with the firm. You're fully exposed to idiosyncratic risk. You're looking at one firm and you're hedging that using just systematic risk, right? Index futures. So in my opinion, it's been a little bit of a miracle that it works so well. But this is an example of how you can use futures to hedge an individual share futures contract by adjusting the amount of positions you have based on the systematic risk component of the stock. You're hedging away the systematic risk. The next point I'm going to talk about is very important to understand, and we're going to stress this again later. When people talk about derivatives markets, by and large, the first thing that an organized exchange wants to establish are futures contracts, not options, but futures. Futures, at the end of the day, although they are less sophisticated, they are in fact more useful because they are able to separate idiosyncratic risk from systematic risk and allow you to gamble on the different positions. So I'm going to explain how that can be done. What we're going to show is an example where we're going to speculate on the idiosyncratic risk, the firm-specific risk of the stock. We're going to eliminate all the systematic risk in order to capture the unsystematic return of a stock believed to be unpriced. So, all these examples, they're available on the MyUni website in a PDF blown up, so you can read it easier. In July, you are following the stock Helena Curtis, which has a price of $17.40 and a beta of 1.1. Barring any change in the general level of stock prices, you expect the stock to appreciate by 10% by the end of September. So we think we've found an underpriced stock. It's underpriced by 10%. Your analysis of the market as a whole, however, calls for about an 8% decline in stock prices in general over the same period. So the problem that we have, and this occurs quite often in fact, particularly if you look at last year, stock markets around the world have sort of flatlined, they haven't really gone up or down. But you have isolated, you have found a stock that is underpriced. The problem is the whole market's going down. And your stock will also go down because it's associated with a systematic risk component of it, right? So, if the beta of the stock is 1.1, and you expect the market to go down by 8%, then that implies that the stock should also go down by how much? Well, 1.1 times 8%. It should go down by 8.8%. What we want to do is separate the decline in the stock price due to the market going down, its systematic risk exposure, which is 8.8%, to the firm-specific risk, which we think is underpriced by 10%. If all we do is buy the stock, then it looks like we'll just simply make, what, a 1.2% profit, right? It's underpriced by 10%, but we know it'll go down by 8.8%, so we'll just make 1.2% profit. If there is no futures market, then all you can do is buy the stock and make that little bit of a gain. However, if there is a futures market, we can actually make money from this. What position do you think we'll take it with the futures? A long or short position in this case? Short, that's right. We're going to want to short the index future because we're getting rid of the systematic risk. So, in July, I buy 150,000 shares, giving me a total portfolio of $2.6 million. The price of one futures contract is $222,000. I therefore use my equation and go short on 13 futures contracts. In September, the stock has gone up. We did expect it to go up. It has gone up a little bit, right? It was worth 2.6 million. Now my portfolio is worth 2.66 million. So it's gone up by $60,000. Not a lot of money. Not definitely 10%, okay? So, fortunately for us, because I have I deleted my systematic risk exposure by shorting 13 futures contracts that were initially worth $222,000, but now they're only priced at $206,000, I can make money by buying them back. I make a profit from the stock which is close to $60,000, it's $56,000. I make a lot of money from my futures. I make $216,000 from my futures. My overall profit is $270,000. And $270,000 over my initial value of my portfolio of $2.6 million is 10.5%. I've basically made the full value of the underpricing of the stock. I've made a 10% profit. I've been able to do that because I got rid of the market risk associated with an 8% decline in the market. So this is only possible using futures. You have to remember with options contracts, you cannot play around with systematic versus unsystematic risk. That doesn't exist. You can do many other things with options, but you can't basically play around with systematic risk and idiosyncratic risk. And therefore, it leads us to our final case, and there's an example of this that you have to work through in the tutorial. So I'm not going to provide an example, but rather you do it in the tutorial, where you can actually change the beta, the systematic risk component of your portfolio, to any value that you like. The way you do that is to say that I will take a position in futures contracts. How many positions do I take in futures contracts? It's going to be equal to the beta that I want. So this is my target beta, the beta I want for my portfolio, minus my current portfolio beta, multiplied by the value of multiplied by the value of my portfolio, divided by the price of one futures contract. So, in essence, if I want to increase my systematic risk exposure for my portfolio, what do I do? Do I go long or short on index futures? Long. If I want to reduce my systematic risk exposure in my portfolio, what do I do? Short. I go short. That's basically it. And that leads us to this quite profound, insightful conclusion that with futures, we can separate the stock selection, sorry about my writing, the stock selection process from risk management. What do I mean by this statement? Well, I'm actually saying that where there is a futures market, an active futures market, then the stocks that you choose to invest in, that you decide to pick, your stock selection, is independent, is separate to you managing the risk of the portfolio. Let's say I have a client that says they want to own some stocks, but they don't want to take on a lot of risk with the stocks. So that means, do you want the portfolio to have a high or a low beta? A low beta, right? However, when you study the market, you find all the stocks which are undervalued to have high betas. So if there is no futures market, what can you do? Nothing. You can either buy the undervalued stocks and then try to convince the client that they should have a high beta portfolio, a high risk portfolio, because all the stocks are undervalued, they're the only ones you could find, or you don't do anything at all. However, if there is a futures market, it doesn't matter what the beta of the individual stocks are. You don't care. All you focus on is, are they overvalued or are they undervalued? If they're undervalued, you buy them. If they're overvalued and you can short, then you short them. And you get your hold of your portfolio, you work out your total portfolio beta. If the portfolio beta is high, no problems. You go to the market, the futures market, and you short index futures. So risk management of your portfolio is separate from the stock selection process. And that is why people, by and large, no one's really going to disagree with me here, will say the first thing after having a fully functioning stock market is to issue a futures market, not an options market. Options markets have many benefits, but by far what's more important is futures, because suddenly you can separate the choice of your stocks from risk management. And that's why if you work for a large investment bank, you may very well find, and happens all the time, if you're an analyst, an equity analyst, you work in one department. All your job is to research individual companies to work out which stocks to buy. Then when they're bought, there'll be somebody in another department, in the risk management department, working out how do we manage the risk of all these positions. And they're able to do that because they are going to play around with the derivatives market. They're going to play around with futures. Okay. So, I've now explained the two different types of hedge ratios that exist out there in the world. The first type is where you're hedging an individual spot position using a futures that has the same product. So, gold futures with gold, for example, or wheat futures for wheat. The second is where you're using index futures to hedge portfolios of stocks or individual stocks, and having the ability to segregate systematic risk to idiosyncratic risk. So the final thing, well, there's two little things left basically for us to cover in regards to this topic. The first is looking at what we call stock index arbitrage, and the second is to demonstrate to you that there is a relationship between the futures market, the options market, the bond market, and the stock market. They are all interrelated. So we'll come to that very shortly. With stock index arbitrage, what am I referring to here is the fact that there should be a theoretical relationship between the current price of the futures contract, the market price of the futures, relative to the theoretical value. The theoretical value of an index future should be equal to its spot price multiplied by the exponential function to the power of the interest foregone minus the dividend yield. And all that is multiplied by time to maturity. If the market price of the futures contract is above the theoretical value, an arbitrager buys the stocks underlying the index and sells the futures contract. If the market price for the futures is smaller than the theoretical value, then an arbitrager should buy the futures and short the stocks underlying the index. So that's relatively straightforward so far. Let's go through one example. Let's say there's a futures contract that has 70 days before expiry. The index currently is at 2331. The risk-free rate is 4.7%, and the dividend yield is 2.1%. Now, without doing anything further, just by reading this information, you should be able to tell straight away if the market is in contango or backwardation. Which one is it? Contango or backwardation? Just by looking at what I've just read out. Contango, yes. And the reason? Very good. Yeah, the risk-free rate of 4.7% is larger than the dividend yield, right? The convenience yield of 2.1%. As long as the interest rate, the interest foregone, is larger than the convenience yield, you know you've got contango. So, if I calculate the theoretically correct price of the futures contract, it should be at 2342. However, let's say that in reality the market price is currently traded at is 2371. This is too high. So what I'm going to do is go short on the futures and I'm going to buy the index. I then hold until expiration. At expiration I sell back the stocks and buy back the futures, and I'm guaranteed to make a profit that is equal to the difference between the theoretical price of the futures and the market price. Why must I hold until expiration? That's right, because if I don't, I run into basis risk, right? The only way an arbitrage can take place, and arbitrage means money for nothing, right? There's zero risk, but I'm making money, is if I hold to expiration. A question will arise, is it worth me undertaking this transaction? Because although it looks like quite simple, all I have to do is this, at the end of the day, there is an opportunity cost. If I decide to go short on the futures contract at the moment, today, how much does this cost me now? When I go short on the futures now, how much does that cost me? Zero, right? Nothing. But I have to buy the index. Does this cost me something? Yes. So the question is, do I spend my money, or do I borrow money from the bank to buy the index, or do I do something else with it? That's the question I have to ask myself, because maybe it's better for me to do something else. So this leads us to working out something called the implied repo rate. The implied repo rate tells me, is it worth me undertaking this arbitrage, or should I do something else with my money? To work it out, the implied repo rate is equal to the natural log of the current futures price divided by the current spot price, and all that divided by time to maturity plus the convenience yield. In my example, I get a value of 0.1116. As long as I can get financing at less than the implied repo rate, the arbitrage is worth doing. What this is saying is the following. If I can borrow money from the bank at less than 11%, I should do it. If I can borrow money from the bank, but they're going to charge me 15%, it's saying don't bother with the arbitrage. It's not worth it. So it's a simple calculation to determine if the arbitrage is worth you undertaking. There is a second problem, separated from whether it's worthwhile you doing it in terms of money, in regards to an index futures arbitrage, and that is that an index is not an investable asset. You cannot go out there and buy the index. Now some of you might say, well, I can buy an ETF, an exchange traded fund. They're very popular nowadays. It is true, you can sort of maybe get away with it, but it's still not exactly the same thing. For a large bank, if they want to buy the index, they're going to have to buy the individual stocks underlying the index. So with the S&P 500, they're probably not going to buy all the 500 stocks. They maybe buy 20 of the most important ones, right? But still, that involves a high transaction cost. Sometimes all these stocks may not be liquid. You may not be able to purchase or short them at the exact time that you want. So the problem is, even though I'm saying here, oh look, let's just simply buy the index, go short on the futures, sure. It's easy to go short on the futures. That's easily done like that. Buying the index or shorting the index, that's not so easy at all. And therefore, other than the implied repo rate, what you have to consider, particularly if you work for an investment house and you're arbitraging, is that the theoretical price of the futures contract has to diverge, or shall I say the market price of the futures contract has to diverge a large enough away from the theoretical price to make it worthwhile you arbitraging. So what this means is that in practice, if this here, where my hands are, is the theoretical price, the market price of a futures contract will vary above and below it. There will be a buffer zone, a threshold, where an arbitrager will say, oh, look, there is a difference, but it's not worth me undertaking. Transaction costs are too high. Then it gets a bit further away, and someone's going to say, I can make some real money. So there will always be a value of the futures contract that is away from the actual theoretical price. It's not saying the market's inefficient. It's just basically saying you can't make any money from the difference. This is different from options. With a delta hedge, yeah, there are transaction costs, but you can sort of try to minimize it. The premium of the option should be close to what people expect to be the implied volatility, the expected volatility of the option. With futures, because with index futures you have to buy the underlying stock, it's not so easy. So basically it will vary between a certain value. So that's what essentially this slide is showing you. The other thing, we've talked about this before, so I won't spend much time on it, is that index arbitrage involves simultaneous trades in futures and many different stocks. And a lot of time computers are used to do this. And unfortunately, there are occasions when the stock price and the futures price move in the opposite direction. So I've already said that before. And that can cause big problems. So your theoretical relationship no longer holds. The theory no longer works for short periods of time. Now, the first example of this is back in 1987. Computers started to be used to automate trades, to arbitrage against the theoretical price versus the real price. And in 87, they had a very naive, very simple way of doing their coding, their program. They basically said, if the stock market goes down by 10%, then automatically sell, let's say, 5% of your portfolio. Of course, if all the programs around for all the banks are saying the same thing, suddenly a drop in the share price makes every computer sell their portfolio, right? And that caused a massive crash. So I was referred to, I think it's called Black Monday or Black Wednesday, I can't remember. Anyway, it was a bad day, put it that way. Nowadays, with an increase in what we call high-frequency trading, nowadays you have automated, intelligent algorithms that work around the world. Things have actually become even worse. You have something what's referred to as flash crashes. One occurred not more than about 6-7 months ago, I think, in the New York Stock Exchange. The New York Stock Exchange index went down by 100-200 points for a few minutes before shot back up again. Why? Because computer programs are sort of manipulating the orders that happen in the system to lead to this sort of behavior. Of course, the exchange is trying to find a way of who was responsible to try to sue them, but it is possible that you have these what we call flash crashes, a very quick crash. And that causes problems if, of course, you are hedging, because you need the futures and the index to move in the same direction, and when they don't suddenly, it causes big problems. You're going to get massive margin calls. And if you cannot pay the margin call, what does the exchange do? What does a broker do? Yeah, it closes your position out, right? You probably have the money to pay the margin call, but when they call you, you don't have it at the right time. I said, give me a day. I said, no, we're not giving you a day. I'll give you 1 hour, right? You can't deliver in 1 hour, we close your position. And then you lose. So it is a very big risk. Okay, finally, and I will not talk about this very much at all, there is a relationship that exists between the option market, so puts and calls, the futures market, forward and futures, the stock market and the bond market. and it's referred to as put-call futures forwards parity. The put should theoretically be equal to a call plus the present value of the exercise price minus the price of one futures contract, all on the same instrument. So, you don't have to write down the equation because it comes up here again. Let's look at an example. In May, we have the S&P 500 index is at 1337. The futures contract on it is at 1339. The June call option is priced at $40. The June put option is priced at $39, and they both have an exercise price of 1340. Expiration is in 18 days' time. The risk-free rate is 4.56%. So, based on this information, we're told that the current put is priced at $39. The question I'm going to ask is that the same as the theoretical price that it should be equal to? So how can we work that out? Well, we can use put-call futures forwards parity. The call should be equal to, the put should be equal to the call plus the present value of the exercise price minus the futures price. So the call is $40. The exercise price is 1340, that's up here. The price of one futures contract is 1339. And we discount that by 4.56% for 18 days. That gives us a put price, a theoretical put price of $40.70. So, the market is telling us the price of the put is $39, but in theory, it should be priced at $40.70. So is the put currently under or overpriced? Underpriced. What do we do? Good. We buy the put. And what else do we do? Short what? The what? I can't, you can still speak up louder. Sell stocks. Oh, okay, got you. Okay, yes, okay. Not exactly, no. So, let me explain. Most people don't realize this. Even though you have done it before, when we talked about proof via arbitrage, the idea is very simple, but people forget this. You've got two sides of an equation. You've got the left-hand side here and the right-hand side. They both should equal the same. The idea of an arbitrage is that if one is not equal to the other, then you go long on that which is cheaper, short on the one that is not, right? So, we know the put is undervalued. We go long on the put. Therefore, we go short on everything that's here. So, we go short on the call. Money in the bank. What do we do with the future? Long. Good. We go long on the future. So I do the exact opposite that's written here, right? Short call, long futures. So on one side, I take the opposite position to the other side. If I do that, I can guarantee money. It's simple as that. Buy the put and futures, sell the call and the bond, and I make a net profit of $1.70, which is the difference between the theoretically correct price of the put and the current market price of the put. Okay. So, that's pretty much it. Okay, thank you very much, and I'll see you next week. It's not uploaded. Okay, I'll arrange for it to be put up. No promise. Okay.